Hi, Matt McAleer, Director of Equity Strategies, Cumberland Advisors, November 8th, just after the close. Here with our CEO, John Musso. Brought John back on this week, 2 weeks in a row. He's a big fan favorite. Had to bring John on with the rip higher in rates this week. 10-year, up 22, 23 basis points, go out at 194, 195. Highest we've seen in some time. Thought he'd give us some comments there. Then we'll rotate back for a few equity thoughts on what we're seeing that we like, what are we seeing that has us at least a little bit concerned. John?
Yeah, thanks, Matt. As you know, talking about last week, we saw rates start to move higher. Look at this week, Matt just mentioned the 10-year up 23 basis points, the 30-year bond up about 23 or 24 basis points to close at around a 243. Interesting, if you went back about 8 or 9 days ago, the 10-year bond was closer to a 150. Now it's close to a 2. If you went back 8 or 9 days ago, the 30-year bond was closer to a 2. Now it's closer to a 2.5. So it has been a really parallel rise in rates in the longer end of the market. Tax-free bonds up about half that much, which is about what you would expect. What we look at often is something like the utility index. And we'll be watching that on Monday when the bond markets are closed but the stock markets are open. And the utility average generally tends to lead the bond market. And that started turning down about 3 weeks ago. So that kind of verified for us the fact that we are playing defense in bonds. It means that we're starting to keep our ammunition dry, but our position on being defensive is being validated.
Explain defensive and how that means in terms of how you position the tax-free portfolio and the taxable portfolio.
Sure. What does it mean to be defensive? It means, yes, we're using a barbell approach, some shorter bonds and some longer bonds, more shorter bonds than longer bonds to weight that barbell to the shorter end and keep durations low. The type of defensive instruments Matt talks about are, for example, in short-term treasuries, treasury bills, floating rate treasuries, things that we call stepped coupons where, for example, Fannie Mae may issue a bond where the coupon rises every 6 months. It's a little different type of animal, but that by itself is defensive. On the muni side, we use things like floaters or bonds with very short calls. We call them cushion bonds. So think about a 5% bond that's callable in the next year or two. Those types of bonds aren't going to move much no matter what interest rates do. So think about all of those bonds I just described as different instruments that have life preservers on them from a price standpoint.
Nice. Thanks, John. Over on the equity side, John mentioned you like to look at the utility index, bond traders do, to give them a little bit of a feel for where interest rates may or may not be heading as an early indicator. We talked about a month ago, 6 weeks ago, about cross-asset indicators and what we were seeing. About back in August, we got that buy signal in late August, have had a nice run through. According to Dr. Chen's work, Leo's work on some of his quantitative analytics, we're starting to see some real greed creep into this market. That shows up in the options market, shows up in some sentiment readings. We do have to pay strict attention to that because, like we were talking about in late August, when the fear number had reached peaks and numbers, areas that we like to push money into the market, we're now approaching an area that we at least have to respect that a lot of money and a lot of emotion has moved into this market in equities. We go out at new highs in the S&P, we go out at new highs in the Qs, NASDAQ. It's been a steady beat higher. If we look at some of our sentiment indicators, we're getting a lot of bullish readings. Folks that have been watching this video for a year or so know we like to pay specific attention to small option traders. They're known as speculative option traders. They're tracked, that information is available. We pay specific attention to it. Call buyers spiked and spiked hard this week. Call buyers are betting that the market's going higher. Keep in mind, the speculative put buyers are what helped tip us off in late August that the market had gotten too negative. So now we have to keep our eyes open here that perhaps people are getting too optimistic, too greedy. We want to lean against greed. We want to lean into fear. So that's it for us this week. Next week, I'm sure, will be another interesting week in terms of fixed income, equity, and even commodities. Oil with a little bit of bid. Gold as a contra-indicator, very weak over the last 2 and 3 weeks, really going back 6 weeks. Peaked and hasn't been able to get too much footing, telling us that some of that fear trade has really dissipated. Have a great weekend. See you next week.
Thanks.